Hello, welcome back to another segment of the 52 Ways Project, where today we're going to be talking about debt reduction. Today I have the distinct pleasure of interviewing another fellow think tanker who's actually used his existing policy for debt reduction, Andre Felder. He's 28 years old, happily married with two beautiful kids, aged 3 and 5. He graduated from the University of Florida College of Pharmacy in 2014 and currently works as a pharmacy manager at a Southern grocery chain. Andre started seeking alternative financial solutions when his credit card debt seemed insurmountable. Without further ado, let's jump into the interview. Welcome, Think Tankers. Today I have a special guest with us, Mr. Andre Felder. Welcome, sir.
Thank you, Eric, for having me, man.
Absolutely. I'm really even more appreciative because, as I understand it, you are actually on vacation. So you've given me this little sliver of your time to really share your story, and I really appreciate it. So thank you.
And man, you helped change the paradigm of my life. The least I can do, at least I can do is take 10 minutes out of my vacation time to help you out.
I really do appreciate it. Where are you actually, by the way? I'm just curious.
We are in Myrtle Beach, North Carolina.
Nice. Now, I heard there's a hurricane coming, and hopefully it's not steering in your direction.
It looks like it is, but we may catch a little bit of it driving back home, but that's all. Okay, well, I
wish you and your family safety there. So today, Andre, we are talking about debt reduction and more specifically how the banking policy can help with debt reduction. I seem to get a little something from every client, right? And you're no different. One of the things I remember from you working with you is an analogy you made. I'll never forget. I passed it on to other people dealing with debt, specifically student loan debt. You talked about student loan debt as being an additional ring, a wedding and a ring that essentially you're going to have there for a long time. You just got to deal with it. It's like, it was a perfect analogy. So I appreciate that, a little bit of wisdom there.
I don't get to foster wisdom very often. I'm glad.
All right. So, you came to us, obviously you had some debt, and you're a very bright guy. You could have dealt with that debt on your own. So talk to me a little bit about the circumstances of how you ended up with the banking policy and what motivated you to kind of follow through to take this unconventional path.
Well, it was seeming like my credit cards, it seemed, you said I can get rid of it on my own. Well, at that time, it really did not seem that way because we were always fighting a losing battle. And I was just constantly researching things, debt consolidation programs, and different kind of credit cards,
right?
All this kind of things to kind of lower my interest rate and kind of help me expedite the credit card process. Well, I just so happened I was going to get some solar panels put on my house, and I didn't get approved for the financing, and so my credit score was too bad.
Right.
And the man actually pulled me to the side later on. He was a real nice guy. And he was like, man, let me forward you this YouTube video. I listened to it was like an hour and 50 long, hour and a half, whatever. And it basically was a video about the infinite banking concept.
Gotcha.
And I went to, and I was just caught in right there. Because I always have an open mind, and it just kind of caught me right then.
Right.
And then that led me to another YouTube video, which led me to another one and another one, which eventually led me to Nelson Nash's book.
Okay.
Ordered that book, read it over like a week or two, and I was hooked. At that point, I wanted to know exactly how do I actually get involved into one. And that's when I did a little searching and found out Paradigm had some good reviews, and that's how I ended up here with you guys.
Thank you for sharing that. I think your path is very similar to a lot of folks' path. I know Paradigm Life has a huge online presence, and it's the reason how I found Paradigm. And as with the think tank, Ryan and I, our dream, our vision is to continue that education with not only our existing clients, it's kind of talking about how to really get the most out of a policy, such as using it for debt reduction, but also in other ways. And so thank you for sharing that. What are some advantages that you've seen of using a policy to pay down debt as opposed to kind of doing it the conventional way?
I don't have much time. It'll take me a long time to explain all the advantages. But the key ones I can think of is the flexibility.
Okay.
The flexibility of you control when you make your monthly payments.
Right.
You control if you want to miss a monthly payment. Of course, in my household, that don't happen.
Yeah, right.
We don't miss monthly payments. Also, it didn't change anything from my normal day-to-day life.
Right.
Another thing is that as far as budget-wise, it didn't change anything as far as budget-wise. Another thing is that my information is out of the public sector. Nobody can pull my credit over like, oh, you have too much credit card debt.
Right.
Oh, I can't approve you for this, which in turn increases your credit score.
Right.
It's absolutely amazing that you can strengthen this policy. You pay yourself interest instead of why give away that money to a credit card company that already has billions when little old me struggling, I'm gonna pay myself that interest.
Right.
And just finding those intricate principles were probably the tipping point for me.
Okay.
Also, okay, no, I'll get to that later. Maybe.
Okay. All right. Well, listen, what I heard from that was flexibility, control, self-reliance, really reclaiming that banking function for yourself. So that interest doesn't have to go to some other credit card like most people are accustomed to, and just accept. So I appreciate that. So talk to me about, when you took your first policy loan, it was meant for, obviously, to pay off a debt. Talk to me about that process. Was it hard, easy?
Easy. I didn't really do it. You did everything. You guys did everything. But just getting the numbers where you want them is probably the hardest thing. And once you know where you want your monthly payments to be or how much you actually want to engage in your policy, was probably the hardest thing of it all. But actually obtaining the policy is really, you guys made it really simple. It just takes a little time.
Okay. And along with that, when you were first coming through the process, you were very excited, very engaged. And I think I attribute that to just all the upfront due diligence that you did on your own. But still, there are the naysayers, the doubters, the people who are going to ask you, why are you doing this? And so talk to me about your fears, concerns, and how you were able to overcome those to eventually, put the policy in place.
Well, when I did a Google search for infinite banking, you know how Google kind of auto-populates what you're going to say next. It said, as an infinite banking, the next word came up with scam. Okay, let me click on this button.
Right.
Let's see what these people have to say. And they didn't really, that was pretty much a hoax. What really did it for me, man, is just look around you. Look around you. If you in a good situation, fine. Don't bother. If you think you have it all and not open-minded about certain things, don't bother. But if you're looking for a change in this period, you look around you. Most people's situations aren't working. They're caught in this vortex of banks, loans, debt. They're caught in this vortex. So if you just look around you and say, okay, 90% of people, it's not working for it. There has to be something else.
Right.
And why not just give this a try?
Right.
Why not just give it a try? And then all the research speaks for itself. All the research, so that's what kind of led me. And that's what I have to say to them.
Okay. And so along with that, as we wrap things up, what sort of advice or feedback would you give to people who are maybe on the fence about this or looking into it? And what would you say to them?
What we are trying to develop is a new life, basically a new financial life for yourself.
Right.
It's something that you have to, just like if you want to stop smoking, it's something that you have to work on every single day. It's a mindset change.
Sure.
You have to know that you are building your own bank, which is a blessing. It's a beautiful thing. You're building your own bank. So in that case, you have to treat yourself and your household as though you are a bank.
Right.
You have to be diligent. You have to make your payments. If you kind of organize yourself to do that, you have to make your payments. You know what I'm saying? You have to charge yourself interest. If that's what I prefer to do, charge yourself interest, because that's what the banks do.
Right.
As long as you treat yourself like a bank and stay diligent is the word. You have to stay diligent.
Sure.
And do your research. And if you do your research, there's no way you won't have a policy by the end of next year.
Wow, that's powerful, man. Hey, listen, those are wise words from a young guy. Well beyond your years, man. Well beyond yours. The typical age demographic average is around 55. Folks who come here, first things out of the mouth when they see the value here is, I wish I had known about this 20, 30 years ago. And you, my friend, are right at that point where they wish they'd known about this.
I know, and don't wait. The sooner you get involved, the more powerful it becomes. I didn't even get into retirement. That's the whole reason. That's one of the reasons why anybody who has a 401k should don't put your money in a 401k. Dump it right into one of these policies and just keep on, and you'll see how beneficial it is.
Hey, listen, man, we're getting into another topic, and I'm going to make sure, with that passion right there, I'm going to make sure I tap you again for that particular interview on 401ks. But thank you for that.
Hey, you got it, man. I mean, what's great, I mean, I didn't even talk about this, but the credit score, the credit application, I talk about getting it out of the public sector. My credit score, I only had this policy for about 11 months now. Credit score went from 620, nobody would even look my direction, to now a 710. In 11 months. And I think I had like 10 credit cards or something crazy like that. I only have 3 now. And those are looking to get paid off within the next year.
Awesome.
So it's just extremely, extremely powerful. But you do have to be diligent with yourself.
Hey, Andre, I'm going to let you go, man. Hey, enjoy the rest of your vacation. I really appreciate this time with you and sharing your experience, your story. Think Takers, we are going to, in the next part of this section, we're going to talk about the map. We're going to look under the hood. We're going to look at how this would have looked for Andre, keeping his privacy in mind. And we're going to take a similar policy, some similar debts, and look at how we can tackle that with the policy. So thank you again, Andre. And to all the rest of you Think Takers, to your prosperity, we'll talk to you again soon.
Beautiful, beautiful. Thank you.
All right. Welcome back, Think Takers. We are going to take what we talked about with Andre, and we're going to actually look under the hood now. We're going to look at the numbers. We're going to look at this from a conceptual standpoint and how this might look on his policy or policy similar to his. But first of all, I just want to say, again, I want to thank Andre. Hopefully you all got a lot out of that conversation. It's always great. It's always good to see a person who has a policy who's actually putting it to work, right, and making it work on your behalf and using it the way that it was intended to be used for. So let's look under the hood here. We are looking at, first, from a conceptual standpoint, I consider debt to fall in one of two categories when you're working with the policy. There's the outside debt and there's the inside debt. The outside debt is any debt that is on the radar, that is in the public domain in terms of credit cards, student loans, car loans, anything that you don't have any control over. Someone else has dictated the terms, and if you don't pay it, you're pretty much screwed. A collections agency is going to come after you at some point, and it'll have ripple effects in a negative way with your credit score and everything else that you decide to do. Okay, inside debt is essentially policy loans, right? Any money that you've paid for to pay off a debt, now you've moved that money inside the policy loan. Kind of looks like this. So you take a policy loan, you've got enough money, cash value, to take a policy loan to pay off a credit card, let's say. Okay, policy loan pays off the credit card. Now that credit card balance is inside the policy, okay? It's inside the policy. Now, what does that mean? What happens there, okay? I break this down into really 3 phases. So first things first, you want to trade outside debt for inside debt. This says inside to outside, but it's supposed to be outside to inside debt, okay? You've done that. You also want to be mindful of trading cash for cash flow, not cash for equity. What do I mean by that? Cash, when you have enough cash value in the policy to pay down a credit card in full, a full balance, do it. You want to trade cash for cash flow because you want to reclaim those payments, that cash flow, so now you can start directing it back into your policy. If you had a $5,000 credit card balance and you had $3,000, you're going to use $3,000 to pay off some of that $5,000. What you've done is, you've got rid of some of that equity. You have $2,000 balance, but you haven't reclaimed that cash flow. In other words, you still got to pay that payment on that credit card. We want to take care of all of that. So you always want to trade cash for cash flow. You also want to be mindful. You want to make sure you have enough for emergencies in your policy. So in other words, if you have $5,000 to pay off a card, and that's all you have in the cash value, don't take the entire $5,000. Leave some in there for emergencies. Okay. And lastly, self-discipline is going to be key. This one probably is the most important. Now you've relieved yourself of having to be beholden to someone else when you pay off that credit card. but now you've moved it into your own system, okay? And you got to be mindful of the fact that you now have to be, you really want to be a good steward of your bank. In other words, just because now you don't have to answer to anyone else about that debt doesn't mean it doesn't relieve you of the responsibility for paying that off. Okay, it just means no one's going to bother you about it. It's on your terms. Okay, but you're only hurting yourself if you don't pay that back off. All right, phase 2, outside debt completely paid off. In other words, at some point you'll get rid of all this outside debt systematically using your policy to pay off that outside debt. Your credit score rises. You now have privacy. All that debt's now inside your policy. You have privacy, and you're back in control. If something happens in your life, then guess what? You can stop making those payments to the policy loan, right? Nothing's going to happen. No one's going to call collections on you. Your credit score is still going to be maintain its high rating. So again, privacy, control, credit score rises. Inside debt's finally paid off. Once you finish paying off that inside debt, phase 3, you've replenished all your cash value. So now instead of being at 0, if you took money out of the bank and paid off a credit card, now all of a sudden with your system, you're paying back that debt in your policy, and you replenished all that money that you paid. And now instead of being at 0, you have all that money ready for something else, ready for an investment, ready for wealth building, and you recapture that interest. So let's take a look at what that looks like. Let's look at some numbers here. This is a policy, again, not Andre's policy per se, but something similar. Okay, he's paying a premium here of $10,500 a year. Okay, for 10 years, and then he goes down to the minimum, and at that point his policy is self-sustaining, and essentially he's not coming out of pocket for that $2,500. Okay, now he's paying that $10,500 initially right off the bat. He has access to almost $7,000. Okay, so what he's going to do, is he's going to take a policy loan for his first 2 credit cards. He had 2 credit cards, a Visa and a Lowe's credit card, that were upwards of 20% APR. Okay, how would you like to get a 20% rate of return on your investment? Well, guess what? Visa and Lowe's, they love Andre because they were getting 20% from him on a pretty consistent basis. They knew with his situation, you heard it from Andre himself, he's going to pay his payments, right? And so they're getting a pretty consistent, nice return. And for those who pay just minimums, you're going to be doing that for a long time. And credit cards love it. Banks love it when you pay the minimums. Okay. All right. So what we're going to do now is Andre's balance on those 2 credit cards combined is $6,500. Okay. So what we do is we take a policy loan for $6,500. He had almost $7,000 to borrow against. Take a policy loan for $6,500, and he takes 2 years to pay that off. Not only that, the insurance company is going to charge him 5%. Okay. But we're going to charge ourselves, he's going to charge himself 10%. So that means he gets an extra $250 a year going back into his own bank. Okay? He's going to pay if you're going to use this as a bank, pay yourself as though you were a credit card company and wanted, as far as determining what your interest rate is going to be. So for Andre, let's just say he decides that he's going to pay himself back 10%, right? The insurance company gets the 5%, but you're eligible, you're able to charge yourself a little bit more. Why not? Because, again, the remainder is all going back into your system to compound over a long-term period. Okay? So what that means is if his policy were doing nothing and just sitting there for 30 years, his premiums would equal about $468,000 over 30 years. But because he's putting that money to work and paying himself a little extra, over 30 years he adds about $2,000 extra dollars into the policy. Again, we're getting into more into the weeds than I want to right now. If you have questions about this, ask Brian or I how this works. But just know he took a loan for $6,500 to pay off both his credit cards, and now the money that was going to the credit cards is now going right to paying down those policy loans. Okay, and he's doing that and completing that over 2 years. Okay, all right. I think that's it. Let's go ahead and summarize this up. So without the policy, sure, you could go about this and do some sort of snowball strategy, paying off each credit card, and after you pay off one, you apply the payments of that credit card to the next credit card, so on and so forth. I wholeheartedly agree with that strategy, and it's something that actually we would do with the policy as well. But you could certainly go about this on your own and use your money to pay off the credit cards, and your credit score would increase. That's the biggest payback. You'd be debt free, the credit score would increase. Okay. What you're getting with the policy is that not only does the credit score increase, you see pretty quick results, but also you're replenishing your cash value. Whereas over here, you're back down to zero, and you're not incentivized to take that cash value that you now. So when you pay off a credit card, you now have money that's freed up. You no longer have money going to the credit card. So for most people, human behavior says, well, I'm going to spend my money. I'm going to spend that money on something else. Well, at least this system incentivizes you to take that money and siphon it right back into the policy. Okay. So by the time you pay that policy loan off, you're not at zero anymore. You actually have you replenish your cash value for more uses for the future, whether it be investments, emergencies, what have you. Privacy. Again, I can't overstate this enough. For those who are really concerned about the public, your debts being in the public domain via credit report, this is huge. To be able to take those loans off your credit report, increase your credit score, and put them on inside your policy, that's huge. Okay, especially in this day and age where people are really we lack a lot of privacy in our lives. Control. Again, those loans are now in your policy and on your terms. Again, if life throws you a curveball, you lose your job, guess what? You can stop paying those loan repayments to the policy loans. Okay, those repayments to the policy loans. You can stop paying those and really focus on whatever is at hand in terms of the emergency. Okay. Lastly, you should say discipline. I don't know what's going on there. System of discipline and accountability. Just by its very nature, you are now incentivized with this system to pay yourself back because knowing that you're replenishing your cash value and knowing that this is going to serve you down the road for eventual retirement, for a family bank, for real estate investing, for your own business, all sorts of things. And so it disciplines you and it makes you accountable, which increases your those behaviors and those habits around money. Okay? That's all I got. Hopefully you all got a lot of this. If you have any questions, contact Brian or I, and we can certainly walk you through how we came up with these numbers, or re-explain any of the concepts you saw here today. All right, thanks. To your prosperity. Take care.